The US dollar is dropping and gold is going up. I have put all of my own money into precious metals. Let's talk about why. Now this video is going to revolve around the US dollar. The importance of the price of the US dollar cannot be stressed enough. The US dollar is the world's reserve currency. The US is the centerpiece of the world's financial system. So the value of their currency is incredibly important across the world for all investors. Now, you can look at the price of the US dollar visually by looking at the DXY. That's the US dollar currency index, and that's just the US dollar priced against a basket of other currencies, mainly the euro, but other currencies in there as well, and just tells you how the US dollar is performing against other fiat currencies. So for the purposes of this video, when we're referring to the DXY, we're referring to the price or value of the US dollar. Now in the financial markets, there's a well-known strong inverse correlation between the DXY and gold. So what does that mean? When DXY go down, gold go up like a rocket. Now this video was largely inspired by a Facebook post by a guy called Craig Tapping. Now he's one of the lead educators at a trading education business here in Australia called Mastering the Markets. Now let's have a look at the post and see what he's saying. Gold versus DXY, an 18-year tug of war since the GFC. Let's zoom out and look at the big picture. Since the global financial crisis in 2008, gold and the US dollar index have been locked in a long-term inverse relationship playing out inside this 18-year rising channel. It is one of the most reliable macro relationships in markets, and it makes a lot of sense. Right now, both assets are sitting at critical extremes. The DXY is pressing the bottom of its 18-year bullish channel, and gold is pressing the top of its own long-term channel. In simple terms, both are waiting for direction. This is the decision point, right here, right now. Here's why it matters. When the US dollar weakens, gold typically accelerates higher. A breakdown in DXY from this channel would strongly support continuation upside in gold. That is the key part for gold and silver investors to have a look at there. When the US dollar strengthens, gold usually struggles. A bounce in the DXY from here raises the probability that gold has put in at least a medium-term top or is about to enter a deeper corrective phase. Markets rarely give clean signals in isolation. This is why intermarket analysis matters. You cannot properly assess gold without watching the dollar. So the roadmap is straightforward. A weaker US dollar leads to gold upside continuation. Stronger US dollar leads to gold likely topping or entering a correction. At this point, gold is extended and DXY is compressed at support. Something is about to move. Whichever breaks first will likely dictate the next major swing across precious metals, commodities, and broader risk assets. Watch the dollar, gold is waiting on it. Now, Craig is absolutely bang on the money with his post here. We can see that inverse correlation clearly on the charts, so let's have a quick look. Now, you can see here that in July of 2014, the DXY bottomed and started a big rally. Now, over that same time period, until the DXY topped in January of 2017, gold essentially moved sideways. It did a whole lot of nothing. But that top in the DXY in 2017 marked a bottom for gold, and until the DXY bottomed again in December of 2020, gold was in an epic bull run up. Now you can clearly see that DXY bottoming in 2020 and then ripping up until September of 2022 meant that gold essentially traded sideways and down. And you can see that that September of 2022 peak in the DXY also marked the bottom in gold, starting the beginning of this epic bull run that we've seen over the last 3 years since. And over those same 3 years, the DXY has been in a downtrend. So now you can clearly see why Craig Tapping says that you need to be watching the DXY, particularly if you're a gold or silver investor, and especially if a lot of your investments are in US bonds. Because even when you're winning, you're losing. What do I mean by that? Let's say that the US bond is returning you 4.5–5%. That sounds great, but the Aussie dollar is up over 12% against the US dollar in the last 12 months, meaning that you're actually behind in Aussie dollars on that investment. Not good. Now, going back to Craig's analysis, it is clear to see that we are at a major decision point for the DXY. Either it bounces here or it drops through this 18-year channel that it's been trading in, and we see a big long-term move to the downside in it. Now, where I've put my own money is betting on this DXY going to the downside. And I've made this decision for two reasons: de-dollarization and the insurmountable US debt. Now, let's talk about de-dollarization. Now, de-dollarization is a growing trend among central banks across the world of pivoting away from the US dollar. Now, this trend can clearly be seen on charts looking at central banks' reserve holdings, where you can see that the percentage of their holdings that are US dollars or US bonds are dropping like a stone, whereas the percentage of their holdings that are gold are increasing like a rocket. So this is a clear shift away from US bonds and US treasuries towards gold. Now, on the note of de-dollarization, you can see it on the charts with the DXY. So you can see that the DXY topped in September of 2022, which is about the same time as when Russia invaded the Ukraine. Now, why is this important? Well, because at that point in time, the US decided to seize hundreds of billions of dollars worth of their bonds owned by the Russians. Now, the importance of this cannot be stressed enough. This was the first time in history that we've seen the US weaponize its currency. Not even in World War II did the Allies seize the bonds of the Germans. This is groundbreaking. Now, the importance of this weaponization for de-dollarization is that other countries around the world, like China and India, are looking at this going, okay, well, if the US can seize my US bonds whenever I do something that they don't like, I need to keep my wealth in something that cannot be seized. So, hence the shift from US bonds to gold, something that cannot be seized by the US government. Now, interplaying into this is the rise of BRICS. Now, what is BRICS? Well, BRICS is just a group of countries that have formed an alliance where, through increased cooperation, they're looking to decrease their dependence on the US and also the US dollar. Now, the second point is the insurmountable US debt, which can clearly be seen on the US debt clock, where the US has got $38.7 trillion in national debt. They spend $7 trillion a year at the federal level, and they only take in $5.3 trillion in tax at the federal level. So that's about a $2 trillion a year deficit, meaning that the US debt is moving the wrong way. Now, you can also see the US federal debt to GDP ratio, which is arguably more important than just a random debt figure. You can see that in 1980 it was 34.5% of GDP, whereas today we're at 124% of GDP. Now, what this means is that the US is deep in debt. I'd argue past the point of no return. You cannot pay a debt like that back, particularly not when you're running a $2 trillion deficit every year and adding to that debt. Again, going the wrong way. Now, let's bring this back to the DXY. This massive, insurmountable debt load that can't be repaid. How does this affect the value of the US dollar? Well, what is the US dollar? Well, it's like a pyramid where there's some guys at the top that by a government decree or fiat, they tell you that this piece of paper is worth something, and the people down at the bottom, they keep their life savings in it in the bank accounts because they get interest on it. And in the middle, there's a bunch of banks who manage the whole thing and who are governed by those at the top.
It's not a pyramid scheme. It's not even a scheme per se.
Now, the best place to be is at the top because you print dollars out of thin air that everyone else goes to work for. The second best place to be is in the middle because you get to manage it all, drive Rolls Royces and wear $10,000 suits. And at that middle level, you also get to fractionally reserve lend, which is arguably printing currency out of thin air. So life's also really good for you. It's only down at the bottom level where you have to work for this stuff that life's not so good. Now, where to from here? Well, the DXY can either go up or go down. I've given you all the reasons why I believe it's going to go down. But let's talk about why it could go up. Now, the first is increased interest rates. If the US was to massively increase its interest rates, that would incentivize people to save or hold US dollars and get that interest rate on their savings, which would increase the demand for US dollars and increase the strength of the US dollar compared to other currencies with lower interest rates. But why will they struggle to increase interest rates like they did in the 80s? Debt. The world is so deep into debt, we cannot afford higher interest rates. Whether it be at the government level, the US federal debt going from 34.5% to 124%. The government can't afford higher rates. Whether it be at the corporate level with all the corporations that have taken out all these corporate bonds and all this debt, they can't afford higher interest rates. Whether it be at the personal level, mortgages, people who have got massive credit card debt and cars and mortgages and all of this debt, they can't afford higher interest rates. None of us in society can afford higher interest rates, which tells you that they're going to have a really hard time increasing interest rates like they did in the 80s to bring back faith in the currency again. Now, another reason why the DXY could bounce here is if the other currencies in the basket drop harder than the US dollar does. So the biggest currency in the basket being the euro, if the euro was to drop really hard against the US dollar, then the DXY would bounce. Now let's have a look at the Euro USD chart, where you can clearly see that the euro has broken out of an almost 20-year downtrend. So relying on the euro to lose value against the US dollar just isn't a smart idea here. So in summary, people are losing faith in the US dollar and gold is going up. That trend is just beginning and set to continue for a very long time. And that is why I have sat all of my wealth in the precious metals and will continue to have it sat there for quite a while. Now, if the US government somehow brings in its $2 trillion deficit and runs a surplus again, if somehow the US manages to elect a president that isn't on the Epstein list, and if somehow the US Federal Reserve manages to get rates to 20% without blowing up the entire financial system, then I'll sell my gold and silver. But for now, I'm holding it and buying more. What a time to be alive.